Welcome to Third Decade Class 6. In this class, we will build on what you learned about financial assets and their relative risk levels in Class 5. Our focus here will be on strategies you can use to manage risk as an investor. Here are the learning goals for Class 6. All investors face risk, and it takes many different forms. A business you invest in might do quite well or fail altogether. There is market volatility to consider. Inflation could spike and interest rates could move unexpectedly based on the actions of the Federal Reserve or other developments in the economy. Additionally, bond issuers might default and not repay creditors like you. While we can't eliminate risk, there are strategies you can use to manage it. Diversification is one of the tactics that an investor can use to manage risk. If you are invested in a diverse collection of financial assets, the likelihood that all of those will lose value simultaneously is quite slim. You can diversify your portfolio by purchasing a wide variety of assets across many different industries and in different markets, that is, by investing in the U.S. and abroad. In any given year, some of those assets might perform poorly, but others may exceed expectations. The ultimate goal is that the gains outweigh the losses in the long run. As we've already addressed, mutual funds and exchange-traded funds, also known as ETFs, make it easy to invest in hundreds, even thousands of assets all at once. Note that it is not necessary to diversify institutions. It's not a problem if all your retirement savings accounts are with the same provider, such as Charles Schwab, Fidelity, or Vanguard. What matters is diversification of the assets. On the next slide, you'll see an example of the diversity of assets you could invest in through a single mutual fund or ETF. This chart shows you how different asset classes have performed over the last 15 years. Each color represents a different asset class. For example, blue represents small cap stocks, while red represents investments in real estate. The asset class that had the strongest performance in each year is at the top of the year's column, while the worst performer, often but not always showing a negative rate of return, is at the bottom. This display is sometimes called the Skittles chart or the investment quilt. We've included this chart to help you see that there's a certain amount of randomness in asset performance. Take a moment to choose an asset class and track its placement in the chart over the 15-year period displayed. Is its performance consistent? No one can perfectly and consistently predict what will happen in a given year and how investors will respond to unforeseen events. The pandemic is a good example of a shock to markets that was not predicted. This chart serves as one piece of evidence that a diversified portfolio is your best interest as an investor. You never know which asset will be a winner in a given year, but if you own a little bit of all these asset classes, you can benefit from the good years and make up for the bad ones. You'll notice that in most years, the highest rates of return more than offset the worst ones. You will recognize this graphic from the orientation and from Class 5. It's worth reminding you that risk and potential reward in investing move in the same direction. As risk falls, so does potential reward. As risk increases, your potential return also increases. We can use this information to adjust our investing over our lifetime, so at some points in our lives we are likely to invest in riskier assets, and in others we'll want to invest more conservatively and allocate our dollars to lower risk assets. So we know that diversification is a powerful strategy for managing the risk-return relationship in investing. Asset allocation is really just an extension of diversification. When you settle on an asset allocation strategy, you decide how to divide up your investment portfolio among different kinds of financial assets. Here you would ask questions like, how much of my portfolio do I want to invest in stocks? And how much of my portfolio do I want to invest in bonds? And you could break those decisions down into categories within those two big asset classes as well. When thinking about asset allocation, it can be helpful to begin simply and focus on just two different kinds of financial assets, stocks and bonds. Of course, there's quite a bit of variety within these categories. Here we'll consider the asset class as a whole. The next step is to consider how an investor with a particular risk capacity might divide up their investment dollars between these different categories. Your portfolio's asset allocation at any given point in your investing lifetime will be informed by your risk capacity. The higher your risk capacity, the more aggressive your asset allocation strategy. The lower your risk capacity, the more conservative your asset allocation strategy. Asset allocation allows you to vary the amount of risk you take on in different phases of your life. Generally speaking, the younger you are, the greater your capacity for risk. Because you have decades before you would need to start living on your investments, it would be reasonable for your portfolio to be dominated by stocks rather than bonds. As you get closer to retirement, however, your asset allocation would slowly shift. Because it would be too risky to be invested almost entirely in stocks when you are on the brink of retirement, you would decrease the percentage of stocks and increase the percentage of bonds in your portfolio. A portion of your portfolio may also be shifted to very low-risk assets like money market mutual funds and inflation-protected bonds. Your income and savings rates are other factors influencing your risk capacity and therefore your asset allocation plan. Income stability and a high savings rate mean you are better positioned to weather and recover from investing losses, so you can afford to have a more aggressive asset allocation strategy. Lack of income stability and a low savings rate would make a somewhat more conservative asset allocation strategy appropriate. This chart illustrates how different asset allocation strategies have performed historically. In the first row, you will see how a portfolio made up entirely of bonds performed over nearly 100 years, whereas the last row shows how a portfolio made up entirely of stocks performed over the same period. The rate of return on portfolios weighted more heavily towards stocks demonstrate higher volatility, but also higher returns than those weighted more heavily towards bonds. This pattern, although not guaranteed to persist in the future, can inform our asset allocation decisions. Rebalancing goes hand in hand with asset allocation. On the next slide, you will see a short video that shows how they work together in a practical example involving a young investor.
Strategic asset allocation is a portfolio strategy that involves setting target allocations for various asset classes, then periodically rebalancing the portfolio to maintain these original allocations. Allocations can deviate due to differing returns from various assets. Balanced diversification can reduce risk and improve portfolio returns. Strategic asset allocation is an investment strategy focused on the needs of the investor rather than the constant tracking of the markets and is thought to remove the influence of emotion from investment strategies. Caroline recently opened a Roth IRA with $5,000. Because she wants to remain in the same investments long term, she decides to use strategic asset allocation. Caroline is 25, has a high risk tolerance, and doesn't plan to retire for at least 40 years, so she wants to allocate her portfolio 90% to stocks, $4,500, and 10% to bonds, $500. 1 year later, Caroline needs to rebalance her portfolio to maintain the original allocation of 90% stocks, 10% bonds. Why? Her stocks return 15% over the year, but her bonds return 2%. So her portfolio now consists of $5,175 in stocks, 91%, and $510 in bonds, 9%. She needs to sell $58.50 in stocks and purchase $58.50 in bonds to get back her original asset allocation. She will repeat this review of her allocations every year to maintain her desired percentages. As market returns change, as she gets closer to retirement, and if her risk tolerance changes, Caroline will have a different strategic asset allocation strategy, more bonds, less stock, and thus buy and sell different amounts.
As you heard in the video, rebalancing is just a process for reinstating your asset allocation plan. This is necessary because of varied returns within your portfolio. You will also need to rebalance your portfolio when you decide it is time to alter your asset mix because you've reached a certain age or because your goals have changed. This is not something you need to do on a monthly basis. Once a year should suffice. Now let's consider practical ways for you to implement an asset allocation strategy and use rebalancing to maintain that strategy, and when you're ready, move to a different strategy. One approach is to invest in a variety of mutual funds to achieve your desired asset allocation. So if, for example, you have determined that your portfolio should be 80% stocks and 20% bonds, you could divide your investment dollars into the 3 mutual funds listed here in these ratios. If you had $1,000 to start, $600 would be allocated to the total stock market index fund, with $200 each allocated to the total international stock index and the total bond market index. You could create settings with the custodian of your retirement savings account to divide any contributions to your account according to this plan. This way, all of your contributions are aimed at supporting the asset allocation of 80% stocks and 20% bonds. Then, once each year, you could rebalance as necessary. This would likely mean selling some shares in the stock funds and using that money to purchase additional shares in the bond fund. This can all be done quite easily through the financial institution's website. Note that we're not necessarily recommending these specific mutual funds. It's just one example of how you could use a small number of funds to establish your asset allocation plan. Up next, we'll consider an even simpler option. Another approach is to invest in a mutual fund that manages asset allocation and rebalancing for you. If you estimate that you will retire in 2055, for example, you can invest in a mutual fund that is designed for someone retiring in that year. These are typically called target date or life cycle funds, and the year of planned retirement is usually listed in the fund title. A 2055 target date fund would have an aggressive asset allocation in the 2020s. It would be heavily weighted towards stocks, but would become more conservative. The proportion of bonds in the fund would increase as 2055 approached. You can be strategic here too. If you plan to retire in 2055 but want to have a more aggressive asset allocation for longer, you could invest in a 2060 target date fund. The beauty of these funds is that changes in asset allocation and necessary rebalancing are happening automatically, and you can find funds like these with very low fees. A target date or life cycle fund really can be your one-stop shop for investing. On the next slide, I will show you a sample glide path, which will illustrate the asset allocation plan for one target date retirement fund. I took this glide path from Vanguard's website, but it's very similar to the glide paths you will see for target date retirement funds from other providers like Fidelity and Charles Schwab. This glide path shows how the asset mix in the mutual fund will change before and after the target year. The fund assumes that the target year is when the investor will turn 65. As you can see from the chart, when the investor is aged 20 to 40, the portfolio is dominated by stocks with only 10% allocated to U.S. and international bonds. After age 40, the glide begins, and the percentage of stocks in the portfolio begins to decline, while the percentage of bonds begins to rise. In the case of this fund, the glide continues after age 65 until age 72, and then the asset mix becomes static at 30% stocks and 70% bonds. While all target date or life cycle funds will become more conservative as the retirement year approaches, not all follow the path shown here. The asset mix may become static at the target year or may end up with a more or less conservative strategy. A fund's prospectus will include the relevant details. This graph will help us think about another risk you face as an investor. The turquoise bar on the left shows that over the last 20 years, the S&P 500, a stock index focused on the largest companies in the U.S., has offered investors an average annual return of 10.35%. The yellow bar on the right, however, shows that the typical person investing in stock mutual funds earned a lower annual rate of return of 9.24%. If the market as a whole returned 10.35%, why didn't the average investor earn 10.35%? The gap between the overall market performance and the rate of return investors realized is in large part explained by the behavior of investors. That is, investors took actions that harmed their returns. These actions are largely driven by emotions and cognitive biases that distract investors and lead them to focus on the short term instead of the long term. As we've already discussed in this class, the human brain isn't well aligned to what's best in terms of your financial behavior. Because our brains aren't well suited to think about exponential growth, it's easy to miss the importance of fees. We have cognitive tendencies and biases that can get in our way. Loss aversion is our tendency to feel losses much more strongly than gains of a similar size. Loss aversion can lead us to panic when the market is down and pull our money out of our investments, even if over the long run it would have been much better to leave our investments alone. Hurting and fear of missing out both lead investors to do something mostly because others are doing it. What the masses are doing may not be well aligned to your financial goals. Perhaps the most dangerous risk you pose to your investments is overconfidence. We just aren't very good at knowing what we don't know, and so we systematically overestimate our knowledge and skills. Investors suffering from overconfidence are more likely to engage in excessive trading and less likely to have an adequately diverse portfolio because they are under the impression that they know more than they do. Knowing that these behavioral risks exist is the first step in limiting their negative impact on your investing returns. Participating in an education program like Third Decade can help by providing you with information and tools to avoid classic mistakes like not paying attention to fees. Even more so, working with your financial mentor to develop a long-term financial plan and exercising discipline to stick with the plan, even in the face of market volatility, are two more excellent mitigation strategies. Over the next few slides, we'll explore a few behavioral risks in more depth and provide you with information that can empower you to avoid them.
Don't believe your brain is overconfident? Deception specialist Apollo Robbins is hitting the streets with a game designed to prove you wrong.
I want to play a game with you real quick.
Apollo is going to ask people on the street some trivia questions, and you can play along at home. You don't have to know the exact answer to each of the questions, but just give a range that you're completely confident encompasses the answer. For instance, if I ask you how many continents there are, and you're not sure of the answer, but you think it's around 7, all you have to do is come up with a range of numbers that you're confident includes the right answer, like 4 to 12. Got it?
Okay.
How many countries are in Africa?
The number of countries in Africa.
17.
17. What's your high answer?
30.
30.
Yes.
Okay.
0.
And high.
I'll say 24.
Do you have your answer? Are you confident the correct answer fits within your range? The answer is 57. So how'd you do? Better this time?
Oh, sorry, you missed on that one.
Getting killed.
What exactly does this game have to do with overconfidence? Think about it. You likely had no idea for certain how many countries were in Africa.
So why would you limit the range you gave? Even a little bit.
Almost all of our participants gave extremely small ranges, even though they didn't have a clue. Now are you catching on? You don't need to know the answers to any of these.
Length of the Mississippi River in miles. What would you say the low is?
1.
1? Okay, I think you got part of the system down. High.
3,000.
And submit. Bingo, you got one right. See?
Yeah, I'm getting
You see
this
what the
game.
system is?
Yeah.
You just need to give a big enough range. If any of these answers fell outside your ranges, that means that like 79% of our participants, you suffer from overconfidence.
Here's the solution to the question you answered a minute ago. Did you exhibit overconfidence? Most people do. We're sort of hardwired for it. Let's see an example of how overconfidence might play out in a financial transaction. As more and more well-informed buyers arrive at the garage sale, the price of the painting will get closer and closer to its actual market value. In the initial scenario where there is just one buyer with an insight the seller does not have, there's an asymmetry of information that the buyer can leverage to their advantage. When it comes to buying and selling financial assets, it's not uncommon for people to fall into the trap of overconfidence, of thinking that they are like the one well-informed person at the garage sale. They may believe that they have special insight or key information that they can use to reap outsized benefits in financial markets. First, if you do have inside information and you are using it to profit, In financial markets, that's called insider trading, and it's illegal. In all other cases, economists tell us that investors are unlikely to be able to capitalize on asymmetries of information to beat the market, especially over the long run. Economists have a theory that helps us understand why investors who believe they have special insight about financial assets or the ability to precisely time the market are usually wrong. You'll see a short video about it on the next slide.
What is the efficient market hypothesis? The main idea behind the hypothesis is that the prices of traded assets, such as stocks, already reflect all publicly available information. And thus, if you're investing based on publicly available information, you won't be able to systematically outperform the market over time. Think about it this way. On average, buyers have just as much information as sellers, and vice versa. So that means a stock is just as likely to overperform the market as it is to underperform. Stock returns are hard to forecast because old information is already incorporated in stock prices, and new information is by definition unexpected or random. Here's an example. At 11:39 Eastern Standard Time on January 28, 1986, the Space Shuttle Challenger exploded in a great tragedy, killing everyone on board. 8 minutes later, that news hit the Dow Jones wire service. Things were a lot slower back then before instant messaging. On that day, the stock prices of all the major contractors who had helped to build the shuttle, such as Morton Thiokol, Lockheed, Martin Marietta, and Rockwell International, all fell immediately by 2 to 3%, except for Morton Thiokol, whose prices fell by over 11%. As it turns out, the market had correctly figured out that Morton Thiokol was the most likely cause of the disaster, and within hours, that information was reflected in market prices. A formal investigation would not begin for another 6 months, during which time the failed O-rings made by Morton Thiokol were linked to the cause of the disaster. Now that was back in 1986. Nowadays, new information starts to change markets, not in hours or minutes, but in seconds or milliseconds, literally faster than the blink of an eye, making the efficient market hypothesis that much more efficient. To learn more about the stock market and how it functions as an economic institution, click here. Or to test your knowledge on the efficient market hypothesis, click here. Still here? Check out Marginal Revolution University's other popular videos.
The efficient market hypothesis states that the price of a financial asset, like a stock, is likely an accurate reflection of its true value because so much information about that asset is publicly available. This is unlike the situation in the early stages of the garage sale scenario, where important information was not widely available. The efficient market hypothesis does not perfectly explain what happens in all financial markets, but it does a pretty good job of capturing what happens in the stock market. Companies whose shares are traded on the stock market are publicly held, and so those firms are required by law to publish regular financial reports that help investors understand how likely the firm is to be profitable in the future. This theory's explanatory power has only improved with the widespread use of the internet starting in the 1990s. The efficient market hypothesis implies that it is very difficult to consistently beat the market by purchasing financial assets that are undervalued. That is, assets that other people don't understand the value of, but you do, like the Picasso painting in the scenario, or through market timing. The idea is that if you have important information, other people have it too, and that eliminates your ability to capitalize on it. The problem is that overconfidence sometimes blinds us to this reality. The efficient market hypothesis is an argument against being a day trader or stock picker or believing that there is such a thing as a hot stock tip. Many economists are skeptical that people who bill themselves as experts on the stock market can see what's coming, respond accordingly, and consistently perform better than the market as a whole. I hope your reaction to this information is one of relief. You don't have to monitor the stock market or constantly move your money around, because chances are that won't improve your returns over simply buying a diverse collection of low-cost financial assets and holding them for the long term. To further counter the overconfidence-driven strategy of trying to time the market, study this chart. It shows how $10,000 invested in an S&P 500 index fund would have performed over a 20-year period from 2003 through the end of 2022. The best performance results from leaving the money in the market the entire time. The chart demonstrates that missing just a few of the best performing days is both costly and likely for someone focused on market timing, as 7 of the 10 best performing days over this period occurred in bear markets, that is, times when the stock market had been going down. Many of the behavioral biases I listed earlier drive investors to focus on the short term. Over the next few slides, I want to share evidence to support our emphasis in third decade on going long. We're going to progress through a series of charts that illustrate the performance of the S&P 500 over different holding periods. This chart tells us that if you buy on January 1st and sell on December 31st in any year during this time span, you have about 70% positive returns, some of them incredibly good, and you have about a 30% chance of negative returns, some quite bad. What if instead of holding on to your investment in the S&P 500 for 1 year, you held for 5 years? All of a sudden the results become more positive, not as high, but more consistent. Let's go to 10 years. Everything is compressing. Historically, when your holding period increases, the predictability and likelihood of positive returns increases. With a 20-year holding period, you can see the trend of positive, consistent returns continues. And now we're looking at the time frame that a typical third decade participant is working with. As long as you hold for 30 years and don't panic when everyone is telling you the world is falling apart, the historical data suggests you'll do just fine. This is an average return of 8.5% to 9.5% when you go long. Having the support of an advisor is yet another risk management strategy. While you are a third decade participant, you have access to a financial mentor who can answer your questions and help you make progress towards your financial goals. However, several years down the road, you may find yourself in need of financial advice in connection to your investments. When that happens, we encourage you to be careful in choosing the right financial advisor. A fee-only advisor is likely to be your best option, as they only earn compensation by providing services to you. They don't earn commissions by encouraging you to purchase certain financial products. A fee-based advisor can still earn commissions, and that raises the possibility of a conflict of interest. Beyond an advisor's pay structure, you should probably ask them a series of probing questions to determine the degree to which their approach aligns with your financial style. We've listed a handful of questions here and included additional resources related to this decision in the online classroom. Another option for assistance with financial planning that is growing in popularity is robo-advisors. These online platforms use information provided by you to offer investing assistance, often at a lower cost than a more traditional financial advisor. They also offer incredible convenience as you can work on your financial plan anytime and anywhere. We spent a lot of time in this class on balancing risk and reward. You can use diversification, strategic asset allocation, rebalancing, and your education in this program to reduce your investing risk. Particularly in regards to behavioral risks, we've encouraged you to stay focused on your long-term plan. Historical evidence suggests that buying low-cost, diversified funds and holding them for a long time pays off, even in the midst of recessions and other market disruptions. Take a moment to reflect on the learning goals for this class. How confident do you feel in your ability to do all of the things listed on this slide?